The bond market is whispering. No, it's screaming something is wrong, something big. US government bonds, once considered the bedrock of safety, are being sold off at an alarming rate. Investors, those savvy souls who usually know which way the wind is blowing, are heading for the exits. What's spooking them? The answer lies in two words: trade wars. Tariffs, those economic weapons of mass disruption, are back with a vengeance. The US, under the banner of fair trade, has levied hefty taxes on goods from China. China, never one to back down from a fight, has retaliated in kind. This tit-for-tat exchange has injected a dangerous dose of uncertainty into the global economy. And when uncertainty reigns, investors get jittery. The sell-off in US bonds is a clear sign that investors are losing faith in the world's largest economy. They see a nation embroiled in trade disputes, its currency fluctuating wildly. The greenback, once a symbol of American might, is looking a little pale these days. It's enough to make even the most seasoned investor break into a cold sweat. The bond market is sending a message loud and clear. The US is no longer the safe haven it once was. The question is anyone listening? Trade wars. The very phrase evokes images of economic carnage, shuttered factories, soaring prices, and nations locked in a bitter struggle for dominance. But in the interconnected world of global finance, the consequences of these economic skirmishes extend far beyond the balance sheets of multinational corporations. They strike at the very heart of investor confidence, shaking the foundations of even the most seemingly secure assets. The recent imposition of tariffs, those economic tripwires designed to protect domestic industries, has ignited a firestorm of uncertainty in the global marketplace. The US, long a champion of free trade, has taken a sharp turn towards protectionism. The consequences of this policy shift are already being felt in the volatile swings of the bond and currency markets. Tariffs, by their very nature, are disruptive forces. They disrupt supply chains, increase costs for businesses and consumers, and create an atmosphere of unpredictability that can paralyze investment and stifle economic growth. The current trade war, with its tit-for-tat tariffs and escalating rhetoric, has only magnified these destabilizing effects. The result? A global economy teetering on the brink of chaos. Investors, once eager to pour their money into the perceived safety of US assets, are now looking for safer havens. The bond market sell-off is a clear indication that the trust, once so implicit in the American economy, has been shaken to its core. The US dollar. The stars and stripes, apple pie. These are the symbols of American strength, stability and prosperity, or at least they were. Today, that image of American exceptionalism is being challenged as never before. The greenback, once the world's reserve currency, is showing signs of weakness. The US economy, while still the largest, is no longer the unchallenged titan it once was. This erosion of trust has profound implications for the global financial system. For decades, the US has been the world's safe haven. When storms raged in other markets, investors sought refuge in the perceived security of US Treasury bonds, but the recent sell-off in these bonds suggests that this perception is changing. The US is no longer seen as the guarantor of global stability it once was. The trade war with China, the volatility of the dollar, and the unpredictable nature of US economic policy have all contributed to this loss of confidence. Investors are now questioning the very notion of a safe haven. If the US, with all its economic might, can be so easily destabilized, where can investors turn in times of trouble? The answer, it seems, lies elsewhere. Remember the early days of the pandemic, the fear, the uncertainty, the frantic scramble for financial security? It seems those dark days are back, albeit in a different guise. The current sell-off in US bonds has triggered a new dash for cash, as investors shed riskier assets and seek shelter in the perceived safety of liquidity. This flight to safety is eerily reminiscent of the early days of the pandemic, when markets went into free fall and investors dumped everything they could get their hands on. The difference this time, of course, is that the crisis isn't driven by a global health emergency, but by a more insidious threat, the erosion of trust in the global economic order. The trade war, the currency fluctuations, the political uncertainty, all of these factors have combined to create a perfect storm of fear and doubt. Investors faced with this unsettling new reality are reacting in the most primal way possible by hoarding cash. This dash for liquidity, while understandable in the short term, could have dire consequences for the global economy. When investors pull their money out of the market, it creates a vicious cycle of declining asset prices, reduced investment, and slower economic growth. This is the very scenario that central banks around the world are desperately trying to avoid. But as the dash for cash accelerates, it's becoming increasingly clear that the forces of fear and uncertainty are proving difficult to contain. In these turbulent times, investors are like sailors caught in a storm, desperately searching for a safe harbor. With the US no longer considered the impregnable fortress it once was, they are setting their sights on alternative safe havens. Two assets, in particular, have emerged as beacons of stability in these uncertain times: gold and German government bonds. Gold, the ultimate safe haven asset, has always held a certain allure for investors seeking to preserve their wealth in times of crisis. Its value, unlike that of paper currencies, is not subject to the whims of central bankers or the vagaries of political events. As the dollar weakens and the US economy shows signs of strain, it's no surprise that investors are flocking to the yellow metal. German government bonds, known as Bunds, have also emerged as a popular choice for risk-averse investors. Germany, with its strong economy and stable political system, is seen as a bastion of stability in a sea of uncertainty. The fact that Bunds offer a relatively low yield is of little consequence to investors seeking safety above all else. The flight to gold and German bonds is a clear indication that investors are losing faith in the US as a safe haven. They are seeking shelter in assets that are perceived to be less vulnerable to the economic and political storms that are buffeting the globe. The question is, how long can these alternative safe havens hold up if the storm continues to rage?